They all know that they need to print money or the whole thing's going to collapse. They want to make it seem like there was a debate. I actually believe there's a decent chance that he actually cuts rates this year. I actually think there's a good chance they'll cut in September. He's lying when he says that he's going to control inflation and that we're going to return to price stability, and he knows it. He's a paid professional liar. He has to flip. Mathematically, that's the whole point. There will be a third big print. The first two were GFC and COVID, so it's coming. We print just a shitload of money until our eyes bleed. The people who hold bonds, they are the suckers at the table. Everybody who doesn't have gold will become poorer, and everybody who does have gold will become richer. Something between $20,000 and $100,000 an ounce. Hank Paulson's aware of the issues, and others are as well. And they must have a contingency plan drawn up for, the bond market blows up, and what do we do?
Do you think that gold is somehow part of this break the glass in case of emergency?
Everybody thinks inflation is really bad now. I would say buckle your seatbelt because it's going to get worse.
You are saying that in the next 3 to 4 years, which is a very short time horizon, you think that there is some kind of monetary reset.
This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori, and you are watching The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to show you what is really happening with money, markets, and power. Now, the market believes that Federal Reserve Chair Kevin Warsh is an inflation hawk. My next guest says that interpretation may be dangerously wrong. He says the real story is the mathematics of debt, and that math points to a fundamental transformation of the global monetary system. Larry Lepard is the founder and managing partner of Equity Management Associates and a partner at the Bitcoin Opportunity Fund. He's a professional investment manager and longtime sound money advocate focused on gold, silver, mining companies, and Bitcoin. Larry is also the author of The Big Print: What Happened to America and How Sound Money Will Fix It, which examines how monetary debasement and inflation have damaged the American economy. It's a great read. Larry, good to see you again.
Very nice to see you as well, Michelle. I think you do a great job with your show, and I'm happy to be with you.
Always good talking to you. And last time you were on, we discussed that book at length.
Thank you.
I sincerely recommend everybody gets a copy.
Oh, thanks. I appreciate that.
But Larry, I know you have some very strong thoughts on the Fed. Before we get to the specifics of the Fed under Kevin Warsh, I want to start with the big picture here.
Yeah.
Let's zoom out. If you had to explain what is happening in the global monetary system, what would you say is the real story that most investors are missing or getting wrong? What is the change or changes that investors have not yet fully recognized? And let's try to crystallize this overview in a few minutes.
Yeah, I'll try and keep it brief. I can run on. So there are really two things. Let's start with the first one. I think we're changing systems in that what is going to be considered the world's monetary reserve asset is changing. I think until recently, really for the last 20 or 30 years, the U.S. Treasury Treasury bond was considered the world's monetary reserve asset. I think that's fading fast, and that's obviously dollar denominated. I think what's happening is that's being replaced by gold as the world's reserve asset, because what we're seeing is many countries transacting in their own currencies and then net settling in gold. And I think the reason for that has just been the unreliability of the Treasury bond and its inability to hold value. The Treasury bond has lost an enormous amount of value over the past 6 years. And, it's not paying adequately for the debasement that's taking place. And this is very similar to what happened when back after World War I and coming into World War II, the British pound lost, it used to be the world's reserve currency, and then the dollar replaced it as the United States overtook Britain as the leading kind of manufacturing power in the world. And I think what's happening here is China is overtaking the United States as the leading manufacturing power in the world. The yuan's not ready to be a reserve currency yet because they've got currency controls. It's manipulated, all kinds of other stuff there. But what is happening is the behavior of the United States, the U.S. fiscal deficit, and the dominance of the federal spending has led to a situation where people just aren't trusting the dollar as much. They still trust it. It's good for medium of exchange. In terms of holding value, it's just not doing it. It's getting killed. I mean, dollar performance in gold, silver, Bitcoin terms for the past 10 years, particularly 6 years, particularly since COVID, it's just been dreadful. I mean, it's been absolutely dreadful, and I don't think most investors in the world have really picked up on that. I mean, I think the average U.S. investor is pretty insulated, thinks America's a great country, thinks the dollar's a great currency, and just doesn't see what's going on. And to those of us who are watching it carefully, it's just plain as day that
Hmm.
gold is going to replace the treasury bond, and that's got big implications. And it means gold at 4,000 is just extremely underpriced. It's got to be much much higher if you look at any kind of the historical ratios and so forth. And we've got those in our quarterly report. I would say one other thing quickly to try and keep it within a minute or two. I think most investors today don't understand how inflationary this environment is and how there's really not an easy fix. I think the average investor today has been cushioned by the fact that from 1980 to 2020, when COVID broke out, the basically we lived in a somewhat deflationary world. Interest rates were coming down, the cost of things were getting cheaper. The Chinese additions to the world's productivity really helped a lot, and so you really saw kind of a deflationary environment. COVID came along, the government went crazy in spending, spent $5 trillion, printed most of it, and it reversed that trend. And history shows that once inflation gets going, it's very hard to control. And so in my view, we now live in an inflationary world that, until proven otherwise, will continue. Now, it went to 9% during COVID. They've got it back down into 3 or 4, depending upon how you measure it. But in my opinion, it's going to go back over 9 at some point in the future because we really haven't slayed that dragon. So I think those are two things that everybody's missing.
All right, and that's assuming you take those government inflation
Well, there's that
numbers
too.
that as fact. But yeah, let's operate under that
Yeah,
premise. Before we
pretending that the numbers are actually accurate because we all go to the grocery store and we all pay insurance. We all know that those numbers are understated. Correct.
But before we go to the inflation, you mentioned gold and gold taking over as that neutral reserve asset. That's certainly a theme that we cover extensively on this show and on this
Yeah.
channel. You said that you do see countries net settling in gold. Is
Yes.
that happening? Like, actually, where are we seeing evidence of it,
Absolutely.
of them
Absolutely. I mean,
exchanging goals? Talk us
we
through
can
that.
we can see it by inference. I mean, basically, when the war broke out, and really this is the most recent war, but I'm talking more about actually when the Ukraine war broke out. And the U.S. froze all those Russian assets. A lot of countries woke up to the fact that, hey, these U.S. dollars, necessarily, if they're in a foreign account, they can be seized. We don't like that. And people generally in the past needed dollars in order to buy their oil. And that's why we called it the petrodollar. And so what they started doing is they actually started transacting with each other in their local currencies. And so, okay, Saudi Arabia, you want to sell us oil, and rather than, buy dollars and pay you in dollars, we're going to pay you in yuan. And Saudi Arabia might say, well, gee, I'm not really sure I want yuan. Maybe I want some of that because I need to buy some machine tools from you or so forth. But I'm gonna end up with more yuan than I want. And China said, no problem. We've got a fix for that. We opened this thing called the Shanghai Gold Exchange, and you can convert your yuan into gold, the minute after we pay you. And so now you're getting paid in a currency that won't be debased. And the trend in that direction, and I know you work with Andy. I mean, Andy's documented this extremely well. The trend in that direction, I mean, it's happened in 3 major countries. It's happened with the Saudis, the Middle East, it's happened with India, and it's happened with Russia, where they've all been willing to transact in their local currency and then quote unquote net settle in gold because the currency can immediately be converted into gold. So that's kind of and that's why you see, in the past, I think it used to be, 97% of the transactions in the world were dollar denominated, and that's really declined. I don't know the exact figure today, but the last time I recall researching it fallen into the 60s and was going down. So, that's a trend that supports the thesis that I have, which is the dollar is just losing its reserve status to a degree. Maybe things are still priced in dollars, but people don't want to hold dollars for very long because they know that they're depreciating.
So let's focus on that a little bit longer. Last time, well, not last time, but on a previous occasion that you and I spoke, I believe it was circa 2023.
Yeah.
You at the time told me that we would see the end of the dollar as we know it within 10 years.
Yeah,
So,
I may have overspoke there. It's still possible that the dollar will fail within 10 years. I'd like to revise that statement slightly and say, because the dollar is so ubiquitous and it's easy to quote things in dollar prices, it really is kind of the numeraire. And I've kind of revised my view slightly to we may still have dollar pricing, but it's just not going to be the asset. The bonds aren't going to be the asset anymore. It's not going to be, so as we all know, currencies have two uses, two functions really. Medium of exchange. I pay you quickly, whatever. And then, what you're going to hold once you got it, if you got excess of it. And, dollar might hang around as a medium of exchange for another 20 years. I don't know. I think there's some chance it does still fail in my 10-year window, but I feel less confident about that. That's, something that's to be
Right.
determined. But
But go
but
on.
yeah, when what's really become clear to me since you and I last had that conversation is this trend away from, storing any kind of wealth in dollars. And you just see it. The treasury foreign holdings and treasury bonds have been just declining rapidly since 2014. We can't really get anybody to buy our debt anymore, and that's a whole nother problem that's going to arise. And it's the carry trade that supported the U.S. debt structure, and heaven forbid if that thing blows apart, the Fed is going to be forced to, do what third world countries do when their debt is unsaleable, and that is they're going to print the money and monetize the debt. So that just is so clear now. We've got a lot more touch points since you and I last had that conversation.
And we have, of course, seen since that conversation gold
Well,
overtake
that's
US
that's the other
treasuries
thing.
as the
Yeah,
asset
that's the
held
other
most
thing.
by central banks. And, as Luke Groman, who we both appreciate and admire, says that the dollar will remain the unit of account, the medium of exchange, but that store of value function is shifting away from the dollar and dollar denominated assets and,
Exactly, and
and, and into gold.
let me point to one thing that I think supports what you just said, Michelle. Um, it resonates with my investors who call me up and say, "Hey, we're up a lot last year. Maybe we should get out. Maybe this whole run is over." And you know, I'd say, no, no. On the contrary, silver went up 400% last year. I mean, from the low in 2025 to the high earlier this year at 120, silver went up 4x. Gold went up 65% this last year in calendar 2025. That's only happened once or twice. I mean, in the late 70s, when before Volcker tried to tame inflation and the gold price went to $800. Um, these are really extraordinary events. And it kind of, I mean, as we wrote in the manager's statement to our quarterly report, we looked at those numbers. We said, boy, oh boy, this is game on. I mean, that you don't get those kind of moves in an asset class that big unless something, that's like a 7 on the Richter scale. I mean, something's going on here with gold and silver. Now, obviously, they went too far too fast. They got ahead of themselves. Silver corrected from 120 to 58, gold from 54 to down in the 4,000 range. But I don't, this to me, we're just getting started in this move, and that's to your earlier question of what's something that a lot of people don't appreciate. I still don't think the average investor appreciates that. I mean, yeah, Morgan Stanley went from saying, okay, 60% stocks, 40% bonds, to saying 60% stocks, 20% bonds, 20% gold. But I'll bet you if you went and looked at their client base, very, very few of them have actually implemented that policy. And so we've got to, gold holdings are still trivial in America and in the West in general by individuals and investment accounts. And so, in my view, we have all of that to look forward to as more and more people become aware of the change in this reserve status that I just mentioned.
And so it begs a question, why has gold dropped from that high of around 5,600 to, I guess, as of today, around 4,100, give or take? And many say that that has to do incorrectly with Fed expectations.
Exactly, and
And
that's yeah, it's a great segue into that. I mean, it's so Kevin Warsh comes in. He's the new Fed head, and he is perceived as being hawkish because he wrote an editorial for the Wall Street Journal after he was at the Fed. Interesting data points. He was at the Fed during the GFC, and he was a big supporter of everything they did, all the money printing, all the QE, all the things that were an emergency response. But then afterwards, when he got out, he wrote an editorial and said, in retrospect, maybe printing all that money in QE wasn't such a good idea. Well, that's got everybody thinking he's a hawk. And, you know, I respect what he's trying to do, and it's what all Fed chairmen try to do, which is they try to convince the people that in the world they gaslight us and saying, we're all for sound money, we're going to control inflation. I thought it was fabulous that at his first press conference he said it so many times that I was like, this is, doth this lady protest too much? I mean, it was ridiculous how many times he talked about how they're going to meet their mandate. And the problem is, Michelle, as you and I discussed prior to this interview, was mathematically they can't. And so, and he left himself some outs in front of his congressional testimony. He said, the congressman really did a nice job of asking him, well, do you believe that we would ever do QE again? Or you believe the balance sheet was the problem that created inflation? He says, yes. Do you believe we should shrink the balance sheet? He said, yes. The congressman said, well, if we had an emergency situation where, there was a liquidity crunch, something like COVID or like the GFC, would you expand the balance sheet? He said, yes. So, it's all well and good. It's you can say that you don't believe in God, but then when you're in a foxhole and the shells start coming in, it's hard to be an atheist. And so he just he's going to flip. He has to flip mathematically. That's the whole point. It's another thing that everybody doesn't understand. This isn't all these players on the chessboard. They're all just talking mouthpieces. It's all like kind of a kabuki theater sort of thing. I mean, they really can't control what they have to do, and the circumstances are going to control it. And the circumstance that's bearing down on them is that the debt market is growing exponentially, and without growth, with equivalent growth in the money supply and inflation, they can't support it. And that's just a fact. And so at some point in time, I believe, and this I wrote the book, there will be a third big print. The first two were GFC and COVID. So it's coming. It's just not the tough part for all of us in gold, silver, and Bitcoin is that, meanwhile, the volatility is driving us all nuts, right? I mean, it's no fun. I mean, let's say you bought silver at 120, you're not feeling great today. But, I think longer term, these things are all going higher as a result of this math I described.
We'll get more into the math, but basically, right now, the markets are really seeing Warsh as an inflation hawk. You're
Yep.
saying he's a dove, he just can't admit it yet. So
That's exactly right. Yeah.
talk us more through the clues that you're seeing
Yeah.
that everyone else is missing. And when does this dovish behavior come out?
Both great questions, and let's address your first point that the market sees him as hawkish. Just the CME has a website where they keep the Fed watch the odds and they price out what the
Mhm.
odds are of a rate hike. So this is what the market is currently saying. The market is saying between now and the end of the year, there's only an 8.6% chance of a cut. There's a 32% chance they stay flat, and there's a 60% chance that he raises rates this year. So that would be hawkish, right? So the market, by the way, that's down a little bit from where it was about 2 weeks ago, but that would imply that the market is saying he's very hawkish. Here are the clues, and there are plenty of them. When he, in his confirmation hearing and before, he said to the congressmen and senators, "Look, we're going through one of the biggest technological changes in my lifetime, and the productivity that's going to come as a result of AI leaves us the room to potentially cut rates in order to because of the productivity increases. Cutting rates won't be inflationary because of the productivity increases that we see coming out of those cuts. The other thing is that they've got a very supply side Hamiltonian view of how they should run the economy. And he's specifically said he doesn't believe in the Phillips curve, which implies there's a trade-off between inflation and unemployment, and that raising rates to cool the economy and creating unemployment is cruel, and that the correct solution to the problem is cutting rates to bring supply side into, to get people to invest more because the cost of investing is cheaper, and that therefore you'll get more production, more supply, more goods, and all things equal, more goods, same amount of demand, prices come down. So it's the old Reagan, supply side argument, and there's some validity to that. It's not entirely bunk, but the problem is you cut rates too much and you lead to malinvestment, and it also takes time. And the AI productivity thing, there will be improvements in the economy as a result of AI, but how much, how fast will meanwhile, I mean, if he cuts rates, basically the world is going to realize that he can't fight inflation. And I think the world also realizes, and so he said these things before he was brought in, that he believed in the supply side approach, and he believed AI productivity was going to give him space. He's also said that he thinks inflation is measured incorrectly. So as you and I think it's higher than what they're saying, he actually has leaned on this thing called the Dallas Trim PCI, which is 100 basis points lower. So I think the CPE which they use, I think is saying 3.4. The Dallas Trim version of that is 2.4. So and then he made one final comment that was very interesting. He said, and Senator, I care less about the number after the decimal point than I do about the number in front of the decimal point. And he was alluding to the fact that inflation's at 3.4, and that if he got it down into the twos, so if it were a three starting the number, not a two, or a two starting the number, not a three, things would be better, so to speak. And so that tells me that maybe even 2.5 is acceptable. I mean, their stated goal is two. Of course, I believe it should be zero, and all sound money people believe it should be zero, but that's a different story. Anyway, so those were all the clues, and he's been backed up. I mean, he's very close to Scott Bessent, who's the Treasury Secretary. Bessent made the exact same AI argument, so there've been hints. Now, what happened is interesting because once he said all of these things before we decided to declare war in the Middle East again. So the war broke out, and we got oil run up, very substantially, and we got some very hot inflation prints. And so he was kind of in a pickle. So he certainly couldn't come into his first meeting and sound dovish, because if he did, he'd lose all credibility. So he had to come out and be incredibly hawkish in his first meeting. He did say he wasn't going to offer a dot plot, but he let all the other dot plots stand, and they all showed eight of the 18 showed a hike necessary, predicted. And so, and then he, as he announced that he was going to have these task force to examine AI productivity and how we measure inflation. And so this is a neat device. This gives him the ability in the future to say, well, my expert task force said to me that inflation is mismanaged or overstated. And what am I? Who am I? I'm all for price stability, but I'm going to listen to the experts. And so I actually believe there's a decent chance. I wouldn't say it's super high, but I'd say it's decent that he actually cuts rates sometime this year. I mean, it's certainly higher than the 8% that the market is currently projecting.
Before we continue the conversation with Larry Lepard, a quick thank you to you for watching. Please subscribe to the channel and share our content. I really appreciate you helping us grow this community. And a very big thank you to my partners at Miles Franklin, one of the most respected and trusted names in precious metals for nearly 4 decades. If you're looking to diversify your portfolio and protect your purchasing power, Miles Franklin has a team of experienced advisors and brokers that can help you evaluate your options and make informed decisions based on your individual goals. Contact them at info@milesfranklin.com. And now back to my interview with Larry Lepard. So before we get and unpack that task force, which, as you say, could give him a convenient out here, you think that Kevin Warsh is going to cut rates?
I do.
Year?
I do.
By which meeting? By when?
Well, I mean, I don't know. It certainly before year end, but even possibly before the election. I mean, so it's interesting. So after Warsh had his first press conference, they interviewed Trump over in France. He was at the I don't know, the G7 meeting or something. And he said, "What did you think of his first meeting?" He said, "Oh, it's great. It's all it's all good. Kevin's my guy." Totally. But told me that kind of I think the fix is in. This guy got picked for a reason, and I think here's my prediction, and I'll probably be wrong because I'm wrong all the time. But my prediction here's a scenario that supports our side. The scenario goes as follows: the task force reports back later this summer and says inflation's overstated. We get some cooling in prices, although that's not being helped by the fact that oil's now going back up again since Trump is talking about ramping the war back up. But we get some cooling in prices, and he says, he goes and he has what he calls a good family fight, and even that was kind of an illusion on the Fed board. Even that was kind of an allusion to the fact that they act as though it's really they're debating this thing so seriously and so intelligently. They've got all these great minds thinking about the problem. Oh, horseshit. I mean, they all know that they need to print money or the whole thing's going to collapse, but they want to make it seem like there was a debate about it. And people say, well, he's got to get the votes. When in the past history of the Fed has the Fed chairman not been able to get the votes? I mean, if you read my book or you read about the Thomas Honig story or, Alan Greenspan, all of these guys, the chairman calls the tune and he bullies the rest of the people into doing what he wants to do. And that's his family fight. So, I actually think there's a good chance they'll cut in September. I mean, I
That
really do.
that would be very political, right? And the
It
Fed
it
is
would.
supposed to be apolitical. Whether it is or it isn't is a whole other conversation. And there's certainly been some political posturing from previous Fed chairs, including Powell, including when there was a shift to more
Yep.
ESG driven ideas,
Oh
which many
yeah,
said was
yeah.
political, and when Powell cut rates before elections, which many said was a boost to Biden.
Very much
But
so. Yeah.
but nonetheless, in theory, the Fed is supposed to be apolitical. If there is a cut before midterms, that's I mean, wouldn't there at least be an
It looks
attempt to
looks
preserve
bad.
face?
It looks bad, but if he's got all the data and he makes the argument, I mean, you're probably right. He probably waits until the meeting, the one right before the elections, which probably doesn't have that big an impact on the election. The next meeting is October 28th. So
That's right
yeah,
before the midterms.
yeah,
I mean,
just
it
right
wouldn't have
before
an
the mid.
impact yet in terms of, well, it could have a very quick
Yeah.
market
But
bounce,
you're right. I mean,
I would imagine.
it would be read as political, and who knows? I could be wrong. I mean, obviously, I'm talking my book in the
But
sense
you
that
do see, a cut then in
I
the December
do, I
meeting.
do, because I don't think he was kidding when he talked about this AI productivity, and I don't think he was kidding when he talked about the inflation measures being wrong. I
So, I
really,
mean, he's actually talked about, quite a few things being wrong, right?
yeah,
And hence he has these task forces because he thinks that a lot of things need to be reviewed. And you could say that he's not wrong. I mean, we have all of these data inputs coming in that then need to be revised. So in fact, he announced the creation of 5 task forces aimed at reviewing nearly every major aspect of the Fed's operations, including its communication strategy, less forward guidance, less dot plots, more opaqueness in communication, balance sheet policies, data collection methods. Many say that it's not that it's backwards looking the way that the
absolutely,
Fed currently
absolutely, and I mean, Trueflation says inflation is lower, and one could argue that just as a general rule, I mean, I don't believe in anything the Fed does, but they should be looking out into the future, and if we truly are headed back to a deflationary environment, well, then that would be an argument for a cut. I mean, the thing that
he's also looking at productivity and
yep,
employment analysis. You mentioned the Phillips curve. Many people say, that's wrong. You shouldn't look
I
at,
agree. I look,
employment, raise rates because there's the labor market is tight.
yeah,
Many who do
I
believe in
look,
supply side economics.
I don't disagree with the direction he's going here. I mean, in the sense that I think the Phillips curve is bunk, and I don't disagree with the notion of being supply side oriented. I mean, to be frank with you, I mean, they have to inflate, Michelle, and the only way out of this whole thing, and actually we had a long piece on this too in our quarterly report, is, I mean, the debt to GDP today is comparable to the debt to GDP coming out of World War II. And
Hmm.
how do we get out of that hole? We grew like crazy.
Right.
And so you've heard Trump and Bissett say repeatedly, Trump has said we should have 12, 13% growth. Well, okay, you can get 12 or 13% growth if you make money cheap and run the economy hot. It's what we call the run it hot strategy. The problem with that is it's inflationary. It's very hard to get that kind of growth and keep inflation low if you're running
Just
these
as a
deficits.
recap for our viewers, I want to play that soundbite
Yeah,
of Warsh talking about those task forces, which, as you say, could create the cover to
yeah.
to cut rates and have some. It wasn't me; it was a task force that recommended this. Let's play that soundbite.
I'm appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy. First, Fed communications. Second, the Fed's balance sheet. Third, our use and reliance on existing data sources. Fourth, productivity and jobs in an era of transformation. And last, the Fed's inflation frameworks. My expectation is the task forces will begin work in the next couple of weeks, and hopefully most, if not all of them, concluding by year end.
So again, Larry, you could really make the case, just to play devil's advocate here, the man is not wrong. You do need to review a
Oh,
lot of the current methodology and
totally.
thinking.
Totally. I don't have any problem with that. I'm not saying the man is necessarily wrong, but what I am saying is that he's lying when he says that he's going to control inflation and that we're going to return to price stability, and he knows it. And he's lying when he says he's going to shrink the balance sheet, and he knows it because the math shows you otherwise. That's what I'm saying. Now, he has to say that because that's what he's paid to say. He's a paid professional liar. I mean, and each of these guys, we talk about this in our quarterly report. Each of these guys come with a different style. I've labeled this guy Don Draper. He's our Don Draper Fed chairman. He's handsome, he's well coiffed, hey, what if productivity would eliminate inflation? Let's try that on. That Don Draper meme, and that's kind of what he's doing, right? And okay, great, but that's all fine. But guess what? We're going to have higher inflation numbers showing up, and then what are you going to do, genius? You know what I mean? So I think
So
that's where we're going.
let's assume you're right here,
Yeah,
and he does cut
yeah,
25 basis points before the end of the year.
yeah.
What then? What's
Well, I think it just makes everything cheaper, and it leads to another credit cycle. I think one elephant that's in the room here that we're really not speaking about, Michelle, is if quote unquote something breaks. I mean, there's kind of the normal operation of monetary policy and fiscal policy when the stock market's near record highs and there's no financial distress, and the price of oil is somewhat under control. I think we've also got a bunch of jokers in this deck that are, we've got a war in the Middle East that could severely over time disrupt the supply of oil, and shove the price of oil much higher. We all know how impactful that is on the economy. We've also got, a market that using historical metrics, post 1998 metrics, which is kind of when I think the big money printing began, is at record highs. We've got, a bubble in AI stocks, and the most notable one of which is, it's part AI, it's other things as well, with SpaceX, which is now trading below its initial public offering price. We've got a very highly levered economy with, everybody gambling on, short-term options and so forth. And, we've got a lot of private credit that's gated and mismarked. And so there's a lot of money that could go to money heaven here at some point in the future. And the one thing that a highly leveraged, highly indebted society cannot stand is a downturn in prices and money going to money heaven. That's deflation. That's what Bernanke gave his helicopter speech about. And he said the Fed has a technology that can prevent that. It's called a printing press. And the Keynesians, their dreaded fear is the fear of deflation. And so, and I don't mean just monetary deflation, because that means things are good, prices are cheaper. I'm talking about the kind of deflation that happens when the stock market goes down 30%, or you have an area of the economy blow up like the housing market did. And there's no obvious thing to point to like the housing market, except maybe the capex spend on AI, or some of the private credit stuff. But the point is, we haven't had one of these downturns in a while. And even Warsh admitted himself in front of Congress that if we were to have one, guess what they would need to do? They would need to expand their balance sheet again, which is printing money. And I'm here to say that based on the math, not it's not my personal, it's a personal opinion, but it's an opinion held in the way that an engineer looks at a formula and says, okay, looks at a bridge and says, okay, doing the formula on the tension here and the stresses that this steel can withhold, this is going to work or it's not going to work. Here's the load bearing capacity of this bridge. And I look at the monetary system and I say to myself, this is economically, it's very clear that, this monetary system needs to grow the base money supply at a faster rate that it's growing at. That's why, there's illiquidity in things like Bitcoin and gold right now. And if it doesn't do that, the Fed's going to have to step in to do that because things are going to start to break. And we're already seeing some signs of the breakage. I mean, the 10-year in the US is at 4.7. The Japanese yen is slipping rapidly. The Japanese bond market has been falling rapidly with rates going higher. We've got all these private equity firms gating their redemptions. There are a lot of areas that could potentially create a problem. And, this is the elephant in the room that he doesn't want to address. And if and when one of these things occurs, he's going to be able to come in and say, task force or no task force, he's going to be able to come in and do, what Powell did, which is say, look, I didn't have any choice. I had to do it. It's very similar to what Hank Paulson said back in 2008. He begged Nancy Pelosi to let him, have TARP so he could print the money. And interesting, we should pull up the clip. I think it's very notable that in the last month or two, Hank Paulson came forward and warned about this. I mean, why don't we pull up the clip and then I'll comment on it.
This crisis is different, right? If when you hit the wall, and you're trying to issue treasuries, and the Fed is the only buyer, and the prices of the treasuries are going down and interest rates are up, that's a dangerous thing. And so the thing I am talking about now is we know, people say, when are you going to hit the wall? I obviously don't know. It's impossible to know. But the law of economic gravity, you're not going to know that. So, and when we hit it, it will be vicious. So we have to prepare for that eventuality. And I think we need an emergency break the glass plan, which is targeted and short-term on the shelf, so it's ready to go when we hit the wall.
So, Michelle, this is an enormously important interview, okay? This guy was the guy who was around in '08 and solved that problem. He's been, enjoying his grandkids with his hundreds of millions of dollars and in retirement. He doesn't give public speeches. He doesn't come forward. He hasn't said anything for 20 plus years or 16 plus years. And suddenly he comes out in a major media format and talks about what we all see as a problem with the debt markets and that maybe the Fed should have a plan to address it. I mean, that didn't happen by accident, okay? That did not happen that was a classic, insider in the system trial balloon that he was put up to doing. Because he can, and he even admitted, he said, look, the law of economic gravity, right? Those are his words. And that's what I'm talking about. It's just the math, right?
So, Larry, what does this break the glass in case of emergency plan look like? What could that plan be?
I mean, it looks like the last two, which is, we print just a shitload of money until our eyes bleed, right? I mean, but and we could use this to segue into the next piece, which is, I think
Is that his plan? Is that his plan? Just that the Fed continues this role of buyer of last resort of treasuries?
Yes, it's that. But this leads nicely into the next thought that you and I discussed off camera beforehand, which is to say, maybe there's a monetary reset of some type. Okay, and this is a fascinating thing, right? I mean, we've got Judy Shelton saying that Trump talked to her about a gold-backed treasury bond. We've got Trump's son working for a gold company and implying that his father could revalue gold at some point in time. And then we've got a great clip of Scott Bessent, which I think you should pull up, talking about how, at some point in time, this all is going to have to be addressed.
Right, and I believe you're referring to when Scott Bessent was speaking very early on that he thinks that there will be some kind of Bretton Woods restructuring, a realignment, and that he wants to be at the table when that happens. Judy Shelton did say that she had conversations and expected there to be a long-term U.S. Treasury backed by gold, but she was expecting that to be announced to coincide with the 250th anniversary of American independence. There was a lot of hope in the gold world that we would hear something to that effect come July 4th. That date came and went. There was no indication that there was any movement towards that. We did a couple of weeks later, though, have this the curious conversation on Fox News between Treasury Secretary Scott Bessent and Jesse Waters, all of a sudden talking about the gold that America has. And, to your point, a point that you've made, this is an administration that has repeatedly brought up the topic of gold, certainly more so than any other administrations. We can now play that Bretton Woods realignment soundbite that Scott Bessent was referring to, I think before he even officially began his tenure as Treasury Secretary. And then we can follow that up with him making those comments about Fort Knox. Let's listen to those.
I also felt very strongly that we're in the midst of a great realignment and of a Bretton Woods realignments coming in terms of global policy, global trade. There's a lot of what I taught at Yale. I've been studying my whole life. I'd like to be part of it, either on the inside or the out.
These are the displays of our currency over the years. Some of it, like we used to have silver certificates. We used to be backed by silver, sometimes gold. And then in the 70s, we just went to what was called fiat currency, where you didn't have to keep gold or silver in the vault. If any of these are still outstanding, though, the silver or gold for them is at Fort Knox, waiting for them to be claimed if so needed.
Have you visited Fort Knox?
I haven't. People on my staff has. We're going to the Treasurer's office. The Treasurer has been to Fort Knox. And I am happy to say all gold is present and accounted for. The U.S. has the largest pile of gold in the world, over $1 trillion at current market value.
And we're getting more gold from Venezuela, I hear.
We're getting a lot from Venezuela. We're getting gold. These oil sales are going great. It's going back to the Venezuelan people.
So, Larry, let's put aside the fact that he got it a little bit wrong in terms of being able to redeem those certificates for physical gold and silver. You cannot do that, and you haven't been able to do that for several decades. Let's also take him at face value, which many people would contest, that the gold is actually in Fort Knox and accounted for and not rehypothecated and is really there. Let's just go along with that for
Okay.
now. You hear him making these comments. You hear him talking about a Bretton Woods restructuring. We began this by talking about former Treasury Secretary Hank Paulson saying that there's going to be a break the glass in case of emergency moment and that the Fed needs to do something about it, which led us to this conversation. So let's assume that the gold is there. How do you put those ideas together? Do you think that gold is somehow part of this
I
break the
do.
glass in case of
I
emergency?
Yeah, I very much do. I mean, I think that look, whether gold's there or not, that's a lengthy discussion. My belief is it wasn't there. They might have refilled it earlier this year. I think your partner Andy Scheckman has the same view. So it's probably there now based on him making these statements. But I find it fascinating he's making these statements. I mean, just what it tells me, what I conclude from this, is that he's very aware of these issues. I mean, Hank Paulson's aware of the issues, um, and others are as well. And they must have a contingency plan drawn up for, the bond market blows up, and what do we do? And so, I think it could be something, very similar to, Roosevelt, not in the grab the gold's point of view, but in a reset where they say, look, we are returning, um, the monetary system gets in deep trouble. We have another GFC like moment or COVID like moment. A lot of money is printed. The bond market continues to fail. The currency, inflation takes off. The dollar continues to depreciate very rapidly. And, literally for, strategic national security purposes, they declare, kind of force majeure and say, we are now revaluing the dollar in gold terms. And, we now stand ready as the US Treasury to buy and sell gold at, pick a number. I mean, depends on how much coverage you want of the outstanding money supply. I mean, it's something between $20,000 and $100,000 an ounce, which is a long way from $4,000 that it's at right now. And whether they pick that number correctly or not will determine whether people who have gold will sell it and take dollars, or people who have dollars will give the dollars to them and take the gold back. But basically, in gold terms, everybody who doesn't have gold will become poor, and everybody who does have gold will become richer. And we would be back if the true exchangeability was there and was maintained on a going forward basis, we would have actually returned to the gold standard. And we'd be back on sound money if they honored it. Now, can they and will they do that? I don't know. It would probably take quite an emergency to give them the cover to do that. But I've got to believe that I mean, all these clues, all this, gold, everything coming out of the Trump administration, I got to believe that this has been talked about or thought about, as
I mean,
kind of
there have been a lot of clues. We've
right.
covered them. I mean, there has been, the president posting on Truth Social the golden rule of negotiating. He who has the gold makes the rules. There has been a paper released by the Fed about previous countries that have revalued their gold. But again, doing something like this, Larry, is very, very, very dramatic. In a way, it signals we do not have faith in our own debt. In a way, it undermines the Fed. It undermines the ability for the U.S. to print its currency. It signals lack of faith in the dollar by the U.S. government. I
Well,
mean,
that's
wouldn't you
right.
say?
And so you don't do it unless the situation is extreme. But you do it because you literally think the currency is failing and you have no other choice but to do it. And so, I like I say, we've got kind of another 2.5 years of Trump administration. and my sense is that they might want to try and deal with this before they get out of office. But from a political point of view, unless there's an extreme event, an extreme emergency, they probably won't have the political cover to do it, and then they'll just leave and we'll continue on down the road. And I don't know if the blue team wins, they're going to put in socialism and print a lot of money anyway, so the currency will fail later. So I don't know. I'm not privy to the plans, but I do know that that they're not stupid and they've thought this through, this Hamiltonian approach that they're taking, and it's got to be one of the things that's potentially on the table. It's got to be, in my
So,
view.
so before we get to how the big print may happen within the
Yeah,
next 2.5 years, and before I unpack that, if I may condense what you're saying, you believe that when former Treasury Secretary Hank Paulson, the man who was at the wheel during the 2008 financial crisis, came out and said, we have to have an emergency plan ready, a break the glass in case of emergency strategy ready to go for when there are no more buyers for US Treasuries. You think that behind the scenes, it could be linked to gold and that there are conversations happening in the background that are being set up for that emergency.
I do. I do. I mean, I think we've been outmaneuvered by China on this front. I mean, the Chinese are accumulating a ton of gold. I mean, just today I thought I saw it in Bloomberg. I mean, this was, today, literally Bloomberg. China's gold imports surged to 173 tons in June. Okay, this is a new record. And they're accumulating gold. They're encouraging their citizens to accumulate gold. Sadly, the U.S. has made a lot of the mistakes in terms of imperial overreach that Britain made, that led to Britain, falling from its leadership position in the world. And China has made a bet on gold, and I think that we may be forced into a position where we have to take the same bet. But we're not there yet, and so it could be a bumpy road, and how the big print will manifest itself, I don't know. I mean, the alternative to the big print is the what I would call the run it hot, high inflation South American economy strategy, where they keep interest rates artificially low, and we try like hell to just generate growth. And the good news is everybody will have a job. The bad news is prices will just be out of control. And my theory behind that is if that persists for very long, and by the way, with each of these monetary events, more and more people wake up, Michelle. I mean, in the 80s and 90s, gold, oh my God, nobody knew about it, cared about it, thought about it. It was an ancient relic. It's become more relevant, in the 2000 to present time frame, and increasingly so now. And so, my sense is that what's going to happen is eventually it's going to be really damn relevant because, people are going to realize what I've been saying, which is the math suggests that you cannot support this currency without continual debasement. And so the bond market's going to revolt. And when the bond market revolts, and this is the debt doom loop that James Lavish and I have been talking about for a long time. When the bond market revolts, the interest rates go up, and that's a doom loop because higher interest rates, the U.S. government's the biggest debtor, so higher interest expenses, and we pay for the deficit by selling bonds. All else equal, more bonds, and those fixed size market rates go higher, and wash, rinse, repeat. It just gets worse and worse until
Mhm.
the currency fails. And we've seen this in emerging countries. We've just never seen it in the world's reserve currency.
Well,
So it's an
Larry,
experiment.
but before we get to that, because it does
Yeah,
sound that ultimately all roads lead to gold anyway,
yeah,
whether it's debasement, if we kick the can down the road and we manage to keep this going longer, your purchasing power is going to decline. You need gold. If it's this big print, you're going to need gold. If it's this emergency plan, somehow linking things back to gold, you're going to need gold. But you mentioned China. If it is this, case of emergency where plan of last resort, where they do come out and somehow bring gold back into the system voluntarily, what does that mean? Because does the US, in fact, have the most gold? We do believe that. They want us to believe that the US does, at least on record, over 800 tons, I believe, over
8,000,
261 million
8,300,
ounces.
8,300 tons. Yeah,
261 million ounces of gold.
yeah.
China on record has around 2,000. But that's the official number. It's believed that it has way more than that. Some
Yes.
estimates have it at 5x, even 10x more than that. If this is the emergency plan, what does it mean for China? China could be in a better position if we now return to some kind of
Sadly, China will be
gold-linked
in a better
system.
position, and that's our own doing. Is the gold in Fort Knox? I don't know. Someday it'll get audited. We'll find out. I kind of, based on what Besant and these guys are saying, I'm not sure they're bluffing. I think it probably is. I think they probably refilled it, but I could be wrong. And China, yes, I agree with you. The import data shows the official reserves of China are understated substantially. I don't know if it's 10x. That'd be crazy, but it's certainly multiples of what they have, more than what they say they have based on what they've imported, because it didn't all go to their citizens. Yeah, China will be advantaged, but the important thing I think for everybody to understand is that these currency events are ugly, and they create winners and losers. And this is what happens in fourth turnings, and we're in one, and this fourth turning is driven by a monetary event. But the thing I've said on other podcasts, because people have accused me of being a doomer, is that actually on the other side of this, things are going to get really a lot better for everybody. I mean, when we return to sound money, the system will work better. The wealth inequality that we have will work better. Interest rates will be set at the right level based on supply and demand for capital. All the grift in Washington will get cleaned up kind of naturally. It's hard. It's very hard to cheat on a gold standard, because possession is 9/10 of the law, and if you have the gold, well, then you have the gold. So um, it what does happen though in these transitions is some people win and some people lose. The people who hold bonds, they are the suckers at the table, as Luke says. I mean, they are the absolute suckers at this card table, and they're gonna lose. I mean, and the other thing that I would say is sad is everybody thinks inflation is really bad now. I would say, buckle your seatbelt, because it's going to get worse, and that's tragic. I mean, I think there's a large piece of this country that's just hanging on by their fingernails because of the inflation, and
So
it's really sad.
I just want to take a moment to thank you all for watching. If you enjoy these conversations, please subscribe to the channel and share our content. Every subscription, every like, every comment, every share helps us reach more and more people. And I'm very grateful for your support in helping to grow this community. I'd also like to thank my partners at Miles Franklin. For nearly 4 decades, Miles Franklin has been one of the most respected and trusted names in precious metals. If you're looking to diversify your portfolio and protect your purchasing power, their experienced team can help you understand your options and make informed decisions based on your financial goals. You can reach them at info@milesfranklin.com. Now, let's get back to my conversation with Larry Lepard. So, Larry, this whole, plan of last resort, bring gold officially into the global
Yeah.
monetary system by the US, that's the tail scenario. That's
Yes,
the outlier.
that's not the base case. No,
That's not the base case. That's the
no,
tail scenario. But you're saying there are conversations being had
feels
between the
that way.
people,
Yeah,
and
based on what these guys have
and
said.
that's a potential a preparation. We'll put that aside. Let's get more to the base case. You're talking about running the economy hot.
Yeah,
As you mentioned, Warsh, Besant, they've been making the argument that AI can come and save the day here. That AI gives the US something that it hasn't had in decades, and that's a credible path to growing faster than the debt in terms of a debt to GDP ratio, right? If AI allows the economy to produce substantially more with the same number of workers, for example, GDP and tax revenues rise, the debt becomes smaller relative to the economy, an aging population becomes less economically damaging. And then you could say supply side at the same time, because businesses can produce more goods and more services at lower costs per unit. AI expands the supply, reduces inflationary pressure, can become deflationary. So, in the best case scenario, America gets stronger real growth, higher revenues, lower inflation at the same time. That improves the debt to GDP ratio and potentially reduces the interest rate burden without requiring the politically impossible austerity that we know is just not going to happen.
that's not going to happen, right?
But why could this not happen? Let's
Well,
let's be
it's
optimistic. Why couldn't
yeah,
AI save the
it
day?
could happen, and look, I hope it happens. That would be the best thing possible for America. I just feel like, we're betting everything on the AI horse, and the AI horse is just getting going, and so, these debt problems and the inefficiencies and so forth in the economy have been building up over years, decades, really. And so we've got this new tool, AI, which really makes people more productive. I know it makes you more productive, me more productive. I want to do research. I can find things so much quicker. That's all great. But, I'm making PowerPoint presentations and I'm doing financial analysis. That's not creating molecules, and at the end of the day, a big part of the economy is creating molecules, which, as Jeff Curry says, you got to produce shit. You got to make aluminum, you got to make copper, you got to make oil. And will AI make people more efficient at doing that? Sure, over time it will. But I get the feeling about AI is that while it will probably live up to and exceed its promise in a 10-year time frame, it's going to fall very short in the next year or two, because the numbers I've described are kind of coming to a head in the next few years. And so it's going to be kind of a little bit of a case of too little too late. And Michelle, AI kind of reminds me, and this whole the theory you just proposed, and I would love for that to happen. Okay, I want to see America thrive. I want to see us all live better, et cetera, et cetera. I would love for what you're describing to happen. However, let me suggest that story, that theory sounds very similar to me to the Doge theory when the Trump administration got in office, right? Hey, we've got a new president. We've got, a tough cost cutter and Elon. We've got, he's got Vivek working with him. We're going to come in here and we're going to just rip the guts out of government. We're going to balance this budget. We're going to take $2 trillion out of it. Well, maybe not two. We're going to take $1 trillion out of the budget, and before you know it, we'll have a balanced budget. That'll be, we'll have the three arrows, we'll have 3% growth, 3% GDP, et cetera, et cetera. I mean, okay, all really good. How did that work out? You know what I mean?
Well, I will push back here because that is a different scenario. And again, that was positive and optimistic, but that's taking away things from government. AI is adding things, right? When that's an
Fair point.
austerity plan, that's cutting costs, that's never politically popular. No
Fair point.
politician that wants to stay in power is going to cut people's
Fair
benefits.
point.
We know
Yeah.
that's how we have
Fair
this
point.
debt in the first place.
It is a little bit of an apple and an orange, but I feel like the optimism surrounding it
Is
is
misplaced.
is a little misplaced,
Well,
it reminds me of the optimism surrounding Doge, and I think sadly, I mean, look, the internet was going to change the world in 2000, and it did. But it took 5 to 10 years before the real winners of the internet emerged, the Amazons, the Googles, etc.
mhm.
Pets.com didn't cut it. you know
So your point is AI could, in fact, provide that
Yeah.
productivity solution, but it's not going to happen fast enough, and perhaps not before we get a big bust, as
Well,
many
that's
people
the
are
thing.
saying.
That's the issue, and it's a race between those two things. And look, I mean, take the optimistic viewpoint. That's fine. You may be right. I mean, it's certainly one of the cases that it happens quickly enough that we're fine. What I would suggest is that, the prices of gold and silver in the past year have told you that we're really in the critical state in the monetary system. Do you know what I mean? That people are losing confidence fast, and we're and I mean things like Paulson's comments about the break glass strategy. I mean, even guys like the last Fed chairman, said, "Hey, we cannot continue to grow this debt at this rate. I mean, it's
Powell,
unsupportable."
you've forgotten his name already.
Yeah, yeah, yeah. He was. I
You
was.
blocked
Yeah,
out Jerome
I was
Powell
having a
already
senior
from your
moment there.
memory.
Yeah, I have forgotten his name. I don't like him, so I don't refer to him. Yeah, that we got a problem with the debt. Okay, great. I respect you for saying that, sir. What are we going to do about it? Because you've been the enabler. I mean, the issue really is the congressional issue and the spending. And by the way, that's not going in the right direction either. I mean, data point from the last week, I just watched a testimony of Hegseth in front of Congress saying, "Look, we can't win this war in Iran unless you give me $1.5 trillion." Well, the defense budget, going into this thing was in the 800 to call it 900, billion range. So that's another 600 billion. we're running a deficit of two trillion right now. So we're going to tack another 600 onto that. I mean, gosh, I just, everything is going in the wrong direction. I mean, the thing that would mess up this trade, I mean, here's the thing, Michelle. I've often said that the zigzags here are hard and you don't know how to play them. And we all just kind of have to hang on to our hats on this whole thing. It's like Dan Oliver's Mermican chart. You get really big swings, but we know we're on the right side of the trade with sound money because we just don't see any, as you point out, we don't see any fiscal responsibility in Washington. And as long as they're printing money, as long as they're spending money and running deficits, there's it automatically creates a need to grow the debt, which exacerbates the problem, the doom loop, as we talked about. So it's just math. It's not anything more than that. And all these people running around, spouting
Talk us through the
narratives
math. Talk us
should
through
look
the
at the
math.
math.
Give us
Yeah.
those numbers, Larry.
Well, the federal debt is close to 40 trillion. It's not quite there yet. Federal interest expense are 1.3 trillion. We actually laid this out in our quarterly report. Again, these quarterly reports I'm referring to, there'll be a link, I think, in the show notes, and they're free. But it's like 25 pages. This is, I mean, the U.S. is kind of functionally bankrupt. I mean, we're spending, $2 trillion more than we're bringing in, and adding it to the tab. And it's interesting. It's even worse than that because I just read recently, and this goes to show how the accounting is a little bit messed up. We ran a deficit of a little under 2 trillion last year. I think it was 1.9 if you round up, and yet the debt in the last 12 months has grown by 3.5 trillion. So it's just, I mean, you compound something at a rate, 6, 7, 8% a year, eventually the numbers get really, really large. And that's okay. I mean, you can support that debt, but you've got it. The only way you can support it, every dollar of debt that gets, taken out, somebody's got to create the interest to pay for that, on that debt. And you can't do that without growing the money supply. And by definition, growth in M2 is the truest measure of inflation. And since 1971, M2 has grown at just under 7% a year. Even though the CPI states that it's only been 3.5% average inflation since 71. In fact, it's been, in my opinion, it's been closer to 7. And so that's why people have to protect themselves by getting into things that they can't print.
So talk us through the scenario that you see most likely, and that is the big print.
Yeah.
Right? Talk us how we get there, and what does that mean in terms of
it's
what
very
is being printed? How does the liquidity enter the economy? Talk us through that.
Well, liquidity enters the economy when the banks make loans and create money that grow M2. And by the way, M2 shrank when Powell tightened after the burst of inflation from COVID. But M2 is now back to growing at a pretty healthy rate. It's growing at 5 or 6% a year. So here's my base case, most likely scenario. Warsh cuts rates later this year, leaning on AI productivity and redefined inflation metrics. Some say that's political. He doesn't care. He just goes forward and says, trust me, it's going to work. That leads to more growth in the economy, and the stock market holds together and goes on to record highs, maybe kind of looking more and more like a crack up boom. Unemployment is low. There are jobs to be found. That's the good news. The bad news is inflation starts to heat up again, and the bond market doesn't like it. And we start getting some inflation prints that are well above 4, 5, 6%. And then the bond market starts to fail or crack. They've repeatedly shown us that when the U.S. 10-year gets to 5% interest rate, they have to do something or they take action. They either jawbone it or they intervene through Treasury repurchases. And they basically eventually, I think it'll be the bond market that will lead to the quote unquote the big print. It's possible that they through jawboning they just hold it all together, but I don't think it's particularly likely because I don't think the bondholders are stupid. And I think that, and the bond market's a big market. And so I think that as the bond market, continues to sell off and interest rates get higher, that makes the deficits get bigger. And eventually everybody kind of sees that the jig is up and that, we've got this doom loop going on. If the Fed were forced to pay 10% interest on its, on its debt, I mean, that'd be $4 trillion a year. I mean, that's basically almost all of tax revenue. I think they bring in 5 trillion, we spend 7. So, that's before, Social Security, Medicare, defense, all that other stuff. So effectively that's the US going bankrupt. So before that happens, they would implement yield curve control, which is what they did in 1942 when we fought World War II. And so what they would do is they would say, all right, we the Fed stand ready to lock the 10-year at 4% and to lock the short rates at 1 or 2%. And we will buy whatever you're willing to sell. And that's how the Fed balance sheet goes from 6.7 trillion to 20 trillion. And that's massively inflationary. And people continue. I mean, eventually, everyone in the bond market would say, I'm not holding this. You're going to pay me
Hmm.
4% and you're trying to run it hot. And I know inflation is going to be higher. Sure. Here, Fed, sold to you. It's your bond. And what does the Fed buy that bond with? Newly printed money. And so I guess the point I'm trying to make, this is how currencies fail, Michelle. When everybody realizes the system and the math is such that they can never stop printing, everyone will want out of the dollar. Everyone will want out of it. I mean, you might use it to pay your bill because your bill is denominated in dollars, but you would never save in it. Nobody would ever hold a bond. Everyone. I mean, talk to people from Brazil or Argentina who've lived through this. I mean, or Weimar. Read the stories of Weimar. You get paid, you immediately convert it into something else because you know that it's losing value day by day, week by week. And that's how, when everybody comes to the conclusion that the currency is no good, it goes to kind of no value, and you have it in wheelbarrows. So, I mean, we're a long way from that, but we're not so far away from having this debt spiral become an issue. And evidence of that is a guy like Paulson saying, hey, maybe we need a break the glass strategy. Well, I'm pretty sure the break the glass strategy is either we do yield curve control or we reset to gold or some combination of both, because those are really the choices that they have. I mean, I suppose the final choice would be they let everything collapse, but that's 1929. And I'm talking about all of these things in the context of a stock market that's healthy. I mean, if the stock market starts to go south, I mean, when the stock market fell apart, when the dot-com bubble burst, stock market went down 49%. When the GFC burst, stock market went down 57%. And the dot-com bubble, NASDAQ went down 82%. And that just ballooned the deficits, and the problem only got worse. So it's funny. We're like a family that, is just way, way, way overspent. But because we've got the biggest military in the world and we're the leading country and we're the reserve currency, we've been able to do it, and people have put up with it. But at some point in time, it's going to come home to roost. I guess that's the point I'd make. And I think that point in time is sometime in the next 3 years, 3, 4 years. I think that the whole thing, just to give you a bigger, longer term view, I think by the early to mid 2030s, we've had a true monetary crisis, and we've had to reset the currency in some form. That they've, the inflation. I mean, because what happens here is at some point, inflation becomes so ingrained and so high and so painful that the voters and everybody else look at a Thomas Massey or a Warren Davidson and say, we've got to vote for somebody who's going to restore sound money. And
Or,
right.
or they vote for someone that promises them more free stuff,
Well,
more socialism.
yeah. Well,
We
okay.
bring
So
in UBI, universal basic
that's
income.
exactly
We bring
right.
in a central bank digital currency,
No, look,
and we're all enslaved in some
that's
socialist
that's right.
dystopian
Yeah, the
digital currency
dystopian
matrix.
view is that it doesn't get solved in the Trump administration. It gets worse, but not bad enough to solve it. The blue team wins. AOC is president. And yeah, they become totally socialist. They hand out UBI and they print like crazy. And we have the big print that way. I mean,
Yeah,
that's COVID too, right? That they just hand out free money to everybody. I mean, the way Gavin Newsom wanted to give people checks to deal with the high cost of gasoline. Okay,
right.
yeah. I mean, it's incredibly stupid.
It's
You
it's
know,
it's just it's unfathomable how people don't understand that just makes everything continue to go higher. But they want the votes, Larry. They want the votes. People don't understand that. I mean, I'm coming to you from New York City. Used to be the capital of capitalism. We now have a socialist running things here. So people like free stuff. But let's go back to that statement because it was very dramatic what you said. You are saying that in the next 3 to 4 years, which is a very short time horizon, you
yeah.
think that there is some kind of monetary reset.
I think that's likely. I mean, 3 to 4 years, so 4 is 26. Yeah, I think that's likely. I mean, it's certainly there will be severe monetary problems in the next 3 to 4 years. Whether we reset it in that time frame depends upon politics and just a lot of stuff that's very, very unpredictable. How painful does it get? What happens to the stock market? How bad does the war get? I mean, we haven't talked at all about the Iran war, but I mean, and this is, I mean, I was just reading Ray Dalio this morning, and he did a really good piece that I highly recommend people read. It's on Twitter, where he talks about, I mean, if we don't regain control of the strait, we lose this war. I mean, and so, um, and that's kind of like a Suez moment where, Britain lost, control of the Suez Canal in 52, and that was kind of the death knell for the pound as the world, the final death knell for the pound as the world's reserve currency. And so, we're at the stage here where, it sadly, this is all not good for the United States. It's really not, and we'll just have to see how it unfolds. But
And I
hopefully,
hear that, and as you said earlier, that the reason people let the United States get away with this money printing is largely because of the United States military,
correct.
and the military might backing the U.S. dollar. I hear what you're saying, that if this war doesn't work out, that's just another crack, a major crack in that confidence. But again, just to play devil's advocate, what if somehow the U.S. does emerge victorious in this conflict? What if there is some kind of, and I don't know how, and it's not looking likely, but what if there is some kind of decisive move that does assert the United States military might, that does assert the United States as a superpower, is able to protect global supply chains?
Yeah.
Does that buy more time for King
It
Dollar?
does. It definitely does, and I don't discount that, and I'm not anti-American in terms of, wanting to see this country suffer in any way, shape, or form. But, again, it strikes me that if you look at it at kind of a base level, the problem is that the nature of the warfare has changed, and Groman does a good job with his newsletters of talking about this. I mean, we've invested in these multi-billion-dollar things like aircraft carriers or $100 million things like jets, and sadly, this asymmetric warfare with these drones and missiles, for a lot less money, you can really mess us up, and
Yeah.
that it's unfortunate, right? And so, as a result of that, the scenario you just painted, while I sure hope that's the outcome, I don't see it as being a high probability outcome.
Larry, this is an unpopular view, a very unpopular view, but many military analysts would say that the U.S. has not been allowed to win a war since World War II.
Right.
Now, winning a war means you have to use what many would call decisive, excessive weaponry at your disposal. Now,
Yep.
again, I'm not advocating for this necessarily,
No,
but
I
there
get it.
is,
I get it.
but the U.S. is holding back. The U.S., if it wanted to, it has a lot more. But again, as a
Yeah, I mean,
power that
I think maybe what you're alluding to is kind of the whole nuclear option. I think that holding
doesn't even
back
have
is,
to be nuclear. I mean,
yeah,
I'm just saying that there are many that say because, and again, right or wrong is the whole value ideological debate. It depends if you're Team America, Team World, Team Humanity. Not getting into that, but some would say that the U.S. just has not allowed itself to decisively win a war since World War II because of the cost that comes with that. But if things are this dire, is that is that a tail risk as well?
yeah, I suppose it is. I mean, look, I don't know. I'm not quite sure where you're going there, but um, it's it kind of comes down to the will, and it comes down to whether we should be there to begin with, I guess, in my view. I mean, it's the world is becoming more multipolar, and that has a lot of risks associated with it. And some would say it's a very bad thing that it's becoming multipolar. Some would say it's be a good thing. I personally believe that actually, becoming a little bit more multipolar isn't such a bad thing. I mean, for the U.S. to play the world's policeman, it's been very expensive in terms of both U.S. lives and U.S. treasure. I mean, part of the reason we have the debt that we have is that we wasted some say wasted, I say wasted, others would disagree. that we spent $8 trillion, in Iraq and
Hmm.
Afghanistan, and to try and secure oil, and didn't necessarily get $8 trillion worth of investment. I mean,
Right.
China, by contrast, has played it much more intelligently, and they've taken their capital and they put it into building supply routes and building terminals in other countries, and investing in energy and so on and so forth, and efficiency. And one could argue that it's been a smarter strategy. And I'm not pro Chinese per se. I'm not pro Russian either. But I'm saying it, just looking at it objectively as a geopolitical analyst. I think sadly we've kind of misplayed our cards in some respects.
And that's indeed a valid point. And I only bring up that scenario in the context of how you were painting the fourth turning, and that we are again in the crisis phase of the fourth
Yeah, no,
turning,
and I mean,
and that usually does come with.
no, it's a great point. I mean, you've got the fourth turning, you got the Thucydides trap. I mean, I've forgotten the guy who wrote that book. Basically, Graham basically said, look, you've never seen a change of these world powers without there being a major war. And God knows, I mean, we might have to go there, and God knows you could have nuclear exchange, all of which would be just absolutely horrible. I prefer to think that actually the terror of what happened in Japan in 45 has kind of calmed the world down to the point where everyone realizes that's just not a door we want to open again, and that we can actually have a fourth turning, a monetary fourth turning, which would be economically really messy.
Mhm.
But we can have it without necessarily having a war. I
Well,
mean,
let's talk about the most likely scenario here in
yeah.
with this conflict as well, and that is it kind of grinds on somehow. Talk us through your base case
Well,
with a conflict, with a big print, with
yeah. So
this
what I would
monetary
hope happened,
reset.
what I thought was going to happen, and what I would hope would happen, to be honest with you, was that Trump would declare victory and go home. I was really, and some would say, well, it's not really a victory if they control the strait. I don't give a shit if they charge a toll for boats going through the strait. I just don't give a shit. That's just part of the cost of doing business there. Fine. And everyone says that's a great strategic victory for the United States. Horseshit. It's not really. I mean, it's a part of the world that, in my view, we shouldn't be involved with. And it's not our job to police the world. Now, that's just my libertarian worldview. I know there are other people who strongly disagree with that. But I think ultimately that's where we'll come out, because I think what they'll realize is that the alternatives are just very, very bad. I mean, you talk to any military person who's wise on the situation. I mean, we're not going to conquer Iran. I mean, boots on the ground just isn't going to work. Now, what I think they're hoping is that by just keeping pressure on with the bombing and the things we're doing will eventually lead to some kind of internal revolt. And maybe it will. And I hope they're right about that. But if they're not, my suspicion is what they'll do, if being the politicians that they are, and they're not entirely stupid, is they'll declare victory and let Iran charge for going through the strait. Big deal. And that'll keep the world somewhat on an even keel. And maybe we'll have high inflation here, and the price of
Mhm.
gold and silver will be much higher, and maybe that'll ultimately lead to a bond crisis and a big print, and maybe we'll ultimately reset to sound money. But I think the alternative to that is we just live in a very inflationary time for the next 10 years. And so either of those two outcomes, where we have something really breaks and we have a big print, which is probably my base case, or we kind of keep it, they hold it all together, but it's inflationary. Those are my two most likely cases, with the tails being, a major war, or, such a bad break that we do a monetary reset. Those are kind of the two things I think are most likely.
So let's talk about the portfolio protection strategies for
Yeah.
those scenarios, because it sounds like you're saying you're holding bonds, you're in trouble.
Yeah.
Um, it sounds as though you're saying as well that equities may benefit from
They
you know
might. Yeah.
so talk us through this. What is the portfolio
Well,
protection
as
strategy
I
for
always
these
say, it's
scenarios?
pretty simple. The issue of our day is that government can print money, and they're printing more and more of it to keep their system going, because they can't face the facts that they're not running they're running huge deficits. So that's the start. And if that's the case, then if you have to save in monies that can't be printed. Saving in the dollar that's a sucker's game. And the three forms of money that can't be printed are gold, God's money, analog money that's been around forever. Silver, same thing. And then Bitcoin is kind of the third leg of the stool, which is, I think, emerging as as a digital alternative to gold, because it's an algorithmically controlled supply of 21 million. I think these are all going to outperform traditional assets, including stocks. Although stocks might keep up, they're definitely going to outperform bonds. I mean, the sucker at the table is the saver or the person who has bonds. I mean, they're not going to get paid back in real terms in a very inflationary world. Um, the 70s were the last really inflationary decade. I think it's interesting to look at the 70s. You look at what stocks did in that decade. The S&P kind of went sideways with a couple of big corrections. Didn't go up a lot, didn't go down a lot, didn't get into a full crack up boom. During the 70s, gold stocks and oil stocks went up compounded 30% a year for 10 years. I mean, it was really something to behold. And so I kind of feel like, we're replaying the 70s here a little bit, where we're going to have a lot of inflation. And we just have to, because, they have to print the money to keep the system going, and that's inflationary. It's just that simple.
Well, let's touch on Bitcoin here
Oh,
before
sure.
we finish up on gold,
Yeah.
because some of our viewers are going to agree with everything you say,
I know, and some of them
except
hate it. I get it. That's fine.
except when we come to Bitcoin, right? A lot
Yeah.
of our viewers are going to say, he lost me at Bitcoin.
Yeah, right. Yeah.
So let's talk about that, because last time you and I were chatting, I think Bitcoin was at around 100,000. You said it was going to hit 140 by the end of the year. We've seen Bitcoin crash dramatically. I believe it's at around 64,000 as we're speaking right now. Why
Yeah.
are you still bullish on Bitcoin? What is the narrative that gets
Yeah.
Bitcoin
Well,
back up?
I was certainly wrong about the 140. As you know, it hit a high of about 124 in October of last year. So here we are. Was it I don't know, 8-9 months later, and we're in the mid 60s. So we're down 50%. I think it's very interesting to note that this correction is smaller than all the prior corrections. I mean, Bitcoin corrected 90%, 80%, 70%, 60% twice. And in this particular correction, we're down 54%. So as painful as a 54% drawdown is, it's still not as large as the prior ones. And I think the case remains, sound. And I see things like the Bitcoin ETF, not really losing shares. I mean, in a very severe price correction, you think, well, a lot of people might panic and sell out. But in fact, peak Bitcoin number of shares outstanding in the ETFs is only down about 10% from the peak, in spite of the price of Bitcoin being down 50%. So, my view is that, you still have a pattern of up and to the right with higher highs and higher lows. But obviously, it's an extremely volatile asset, which makes it very hard for most people to invest in. And I say the way you deal with that is you adjust your size. You recognize that it's quite asymmetric to the upside. And I think, 5 years we'll look back and say, gosh, 60,000 Bitcoin wasn't very expensive. It was actually quite cheap. Because I think the next run.
What's the narrative? What's the narrative that gets Bitcoin
Well,
higher?
it's continued.
Is it the printing? What is it?
It's the printing. Yeah, it's the printing. I mean, I think one of the things that's holding it back right now is the Fed. That's probably the biggest thing leaning on Bitcoin, and also on gold and silver, by the way. Is just the Fed is hawkish, and that they're going to fight inflation. I mean, there were a lot of articles out in the last month or two that said the monetary debase. You remember last year, somebody decided to coin this as Bitcoin, gold, and silver became, quote unquote, the monetary debasement trade.
Yeah.
And that was all over the press. Bloomberg and others were saying it. And I saw an article.
Morgan, Morgan Stanley, all coming out with a debasement trade.
Yeah, the monetary debasement. And that's right. And they were right. And that's what I've been playing. About a week, maybe a month ago, sometime in the last month, I saw an article that said the monetary debasement trade is dead. I thought, oh, this is perfect. I think
it was a Bloomberg article.
Was it? Okay. Yeah. I was really pleased to see that. I was like, oh, this is a great bottom indicator, monetary, because it's not, as I've said in our letter, it's not dead. It's just taking a break. I mean, remember, gold was up 65%. Silver was up, 200% last year. The fund we managed, my partner and I, David Foley, managed, it was up 175% last year. I mean, okay, so trees don't grow immediately to the sky. We've got a serious correction going on here. And that's because the Fed we got a new Fed chair, and he's perceived to be a hawk. And he said he's going to fight inflation. And of course,
Yeah, and
That's what he has to say, right?
and
And
we covered that at
yeah, we
at
covered
length at
that
the beginning of
yeah,
this
ad
conversation,
nauseum.
and
So
your thoughts on that.
yeah,
But let
so
me ask you that, and I don't want to get too much into Bitcoin, but
sure.
I have to. Okay, so you're saying the narrative, that gets Bitcoin up again is just more printing, more liquidity,
More
the
printing,
debasement trade back
more
on.
M2 growth. Yeah.
But
And
in the
actually,
meantime, you have
yeah,
critics saying that in the meantime, Michael Saylor and strategy represent a real risk to Bitcoin
yeah,
because they've now taken this
yeah.
asset and
They've
corrupted
sold,
it.
heaven forbid, they
But
sold some. Yeah.
well, some would say they've soiled the purity of the asset with leverage, with derivatives, and the purity of Bitcoin has been corrupt by the fact that it has now entered and become part of the monster of the traditional financial system that it was initially designed to replace, and that ultimately Saylor and strategy and his bonds and leverage may ironically lead to the demise of Bitcoin or to at least a very, very serious crash. What say
Yeah,
you?
and I've heard that story and I've heard that narrative, and it's just that it's a narrative. It's not at all supported by the facts. I mean, Strategy owns 4% of the entire Bitcoin supply. That's 96% that they don't own. The amount they own gets traded, every month. I mean, it's just Strategy could fail and Bitcoin would be just fine. Strategy's not going to fail, by the way, and Saylor hasn't soiled it. I mean, how did to all the Bitcoiners who were down on Saylor and down on Strategy and down on the use of leverage and down on putting it into the existing monetary system, how did they think this is ever going to replace, base money and the dollar and gold without getting integrated into the financial system? I mean, it's not like a bunch of hodlers like you and me and other people who just go out and buy it natively and store it in cold. We're not going to do it. That's just not enough. I mean, you had to have the ETFs come in, and the ETFs gave people who had a stock brokerage account a way to buy Bitcoin because the average person is not going to buy a Trezor and put their Bitcoin in cold storage, right? That's just not going to happen. It's too complicated. But the average person can easily call up their broker and say, hey, I've noticed this Bitcoin thing is performing pretty well. It's been going up for 16 odd years. And even particularly now, they say it's on a 50% correction. Maybe we should buy some. And their broker can click two buttons and they own some. So, that kind of ease of ownership makes it all just more universal. And you're just seeing more and more use cases. You're seeing more and more companies buy it and put it on their balance sheet. You're seeing more and more Lightning transactions, which are growing very rapidly. Lightning is the very low cost network that lets you actually buy things with Bitcoin. People say, well, it's great, but it's digital gold. You can't really use it to buy anything. And I say, nonsense. I mean, you get yourself a Lightning wallet, like a Strike application, put it on your phone. Whenever I go to a Bitcoin show, I can buy a hot dog or a cup of coffee. I pay in Bitcoin. And so, and that'll eventually, I mean, you can go to Steak and Shake. There's a very forward-thinking company that makes hamburgers and hot dogs and shakes. They have one in Naples. I happen to live there, and you can pay in Bitcoin. The CEO says this is the greatest thing ever because we got a lot of our customers buying with Bitcoin, and we don't have to pay the card companies 3%. So it continues to get adopted everywhere, and that's really what I look at, Michelle. I look at the number of nodes. I look at the number of wallets. I look at the number of transactions. I look at the level of adoption, and all of those things continue to grow kind of relentlessly. And so, unless one of those things changes, I mean, the critics of Bitcoin would be right. If everybody suddenly lost interest in Bitcoin and all of those adoption metrics went in the wrong direction, okay, well, then maybe it's not going to keep going up and it's going to fail. But to me, what's going on right now is just your typical bear market, bull market, bear market, bull market. I mean, Amazon, I missed investing in Amazon because it didn't make any money. And I really am pissed at myself for missing it because it became such a fabulously performing stock. And yet it had, numerous 50 and 60% corrections from the time when it was established all the way till today, when it's the dominant online seller of goods
Right.
on the web. And, this is going to emerge, in my view, as the dominant monetary network. And maybe not as the numeraire right away. It's not going to replace gold right away. It's not going to replace the dollar right away, but it's a store of value. It's a digital store of value that is going up and to the right. And none of that's really changed. And it's easy for people to create these stories about how Saylor's going to get liquidated, but any financial analyst worth their salt can pull out the numbers, can look at the amount of debt he's got, can look at the value of his underlying, holdings, and realize that there's just no way this company is bulletproof. I mean, it's just not going to get liquid. He's not going to have to sell a lot of Bitcoin. And so, now to be fair, he did experience, a real learning lesson. So the issue, so what he's doing, by the way, I mean, his model is pretty simple, right? He's buying Bitcoin at a lower cost of capital than he thinks the Bitcoin return will be. And he will fail if the Bitcoin return goes under his cost of capital. So the Bitcoin return historically has been in the 40s. It's coming down into the 30s. And his biggest source of capital most recently has been the stretch product, which is now paying a 12% dividend. So the model he's using is I sell a boomer stretch, I pay them a 12% dividend. The thing I buy, Bitcoin, goes up at 30%, and my shareholders get to capture the difference between 30 and 12. That's the model. It's simple. It's a very simple model. Now, the problem with that is you can't do that forever because eventually stretch becomes too big relative to the Bitcoin he holds, and you get over leveraged. So using a little bit of leverage to amplify your Bitcoin yield, and that's what he's doing, that makes sense. What he got schooled on recently, and this is why everyone jumped on him and attacked him, and I think he just learned his lesson, is that stretch got large enough that eventually somebody got afraid that they weren't going to be able to make the dividend payments. And rather than trading at par, which is $100 a share, it cascaded down. I'll look at my screen here just to get the exact number, but it cascaded down to the point where, for one day it was at $71 a share. So it lost 30% of its value. And that was the market telling him, hey, dude, you're getting too over leveraged. We don't think you're going to be able to make the dividend. And he reacted to that and said, okay, that being the case, I'm going to sell some Bitcoin, and I'm going to create a large cash reserve until confidence returns in this model. And now it's back up to 86, and eventually I'm quite convinced it'll come back to par. So he learned a lesson there. He got a little too aggressive on leverage, and that he'll learn from that. I mean, whenever you're pioneering something new, you're doing something new in a new area, things are going to happen that you don't expect. I mean, you look at Edison, he put electricity in New York, and there were some real accidents that occurred as a result of it. I mean, it's like, anything that's new and different and innovative, comes with upside, but it comes with problems. And, he bumped into some problems here, but to me, they're not fatal. And, this thing's going to continue to go up into the right for a long time. And I think everybody who believes in sound money, if you're a gold person, you haven't looked into it, you should really investigate it. It's not like all the other crypto. It's not Trump coin. It's not Melania coin. It's not World Liberty Financial. It's not any of the horse shit that Sam Bankman-Fried did. It's actually an invention, and the invention is called digital scarcity. It took 40 years in the making, where everybody had all pieces, and some anonymous guy, I think it was two guys, I have a theory on who they were, got together and solved the problem. And so now, and initially I was quite skeptical, but we've now got 16 years of data, and it's worked. And so unless something changes, I don't see how it stops working. That's my view. So,
Well, look, Larry, that is a bigger conversation than we have time for
I
now.
got it. But I had to make the case, though, because I know a lot of your listeners are going to say, "Oh, he's full of
Look,
shit."
there's a lot to unpack there, and from quantum computing
Yep.
to again over leverage to Bitcoin treasury companies failing.
Yep.
Ultimately, my view is no. I'm very open about it. I am a sound money person, therefore I own gold and Bitcoin, and I believe in self custody
Yep.
of Bitcoin, not
You're doing it right.
and not through ETFs. But again, that is a whole conversation.
You're doing it right then. Yeah.
For another time. And I'm a hodler. I have not sold my Bitcoin. So that's just full disclosure from my end. But we will get into, we'll have to bring you back to get into a whole Bitcoin.
I'd be happy to do it. And
there's a lot of resistance still from the gold audience.
The quantum risk, I'm not concerned about, and I get the resistance, and I totally understand why. I would just ask people to be open-minded, and I, remember, I was a gold and silver guy long before I was a Bitcoin guy, and I still am.
And you're still a gold.
I'm still a gold and silver guy. I love them. I own a ton of them.
And so let me bring it to my question here, because we have to start wrapping up. I'm up against your time constraints here. We'll have to get more into Bitcoin. But if you're building a portfolio today, and I know because you're bullish in gold and silver, you're also very bullish on the miners, which you lay out in your letter. But if you're building a portfolio today, how are you balancing gold, silver, miners, Bitcoin, traditional equities.
Well,
Talk us through that.
yeah. So, well, obviously, no bonds, traditional equities. I really don't hold much of, but a lot of people do hold them, and I understand that. Maybe they should. I think that of all the sound money, I think probably gold is the safest, the least volatile, and should be kind of the core holding, particularly as you get older. And I say avoid paper gold. Avoid GLD. You want to own either the Sprott Trust or own the physical yourself. Um, and then you can decide, above and beyond that, how much quote unquote alpha or risk do you want to take on. And silver obviously is more explosive than gold with more upside. And then beyond that, silver stocks are even more explosive than silver. And so, we've got a lot of silver stocks in our portfolio that we think will go up 5 or 10x if silver goes back over 120, which we think it will. It might take a couple of years. And then Bitcoin, same story. I mean, I think Bitcoin looks kind of like silver. It's very volatile. And again, with these volatile assets, I always tell people when they're trying to look at this stuff, the mistake you make with a volatile asset is you can get blown out of it. You can get scared out of it when it turns down. And so you need to buy a number where, if you put 5% of your assets into silver stocks or silver or Bitcoin, which those are the kind of the more risk on sound money choices, I think you got to say to yourself, I know this could go down 50%. I know it. No matter where I buy it, it could go down 50%. And if it does, I'm not going to panic. I'm going to take a 5-year view, knowing that the high likelihood is that as monetary debasement continues, it will come back and go much higher. And I think in all of these assets, I always kind of think the downside is about 50%. But in all of them, I also think the upside, it's not 50%. It's like 100 or 200 or 300 or 400%. I mean, I think, so if you look at a bet and you say, well, what's going to happen here? We don't know. But maybe it's a 50% chance that monetary debasement gets solved and these things go down in value 50%. But it's a 50% chance that monetary debasement doesn't get solved. Maybe it really gets crazy. And, these things are going to go up, 2, 3, 4, 5x. Well, that's a bet you should take, because even though there's some chance it won't work, the upside, if it does work, is so substantial compared to the downside if it doesn't. It's a positive EMV bet. So that's kind of how I view it. And I think everybody just has to look at their own risk tolerances, and say, certainly, look, if you think the world's going to fall apart, there's an argument for holding cash. I mean, think about it. If you held cash in 1929, 3 years later, you got to buy everything at 90% off. I know that because my grandfather actually bought a house that probably would have been 75% more expensive had he not bought it in 1932, because the crash caused the prices of everything to collapse. So, it's monetary stuff is tough because it's volatile. It's really tough.
But that's why many would say gold still gives you that
Absolutely.
protection.
It's the base, it's the base asset, no doubt.
And so, Larry, we do need to wrap up here, but you said that you do see the big print happening, and I'll be generous. I'll say 4 to 5 years. You said 3 to 4. I'll give you 5 years.
Yeah.
I'll make it that
We'll
number.
see. I mean, I could look like an idiot, Michelle. I've been wrong a lot. Okay. I mean,
Well, here's the thing: the direction could be right, and I think many people watching, including myself, agree with the direction. But Rick
who
Rule,
knows?
favorite on the show, always likes to say, "What is inevitable is not necessarily imminent."
He's
So
right.
it's all about the timing, Larry, and
He's
we know
right.
that timing really matters if you're an
It
investor. If
does.
you're early,
It
you're wrong. If you're late, you're wrong. But let's go with that theory. Where is gold in 5 years' time?
Oh, that's a great theory. So 5 years, I think we'll be at $10,000 gold, maybe
That's
higher.
it. We're seeing the world explode, and gold only
Well,
like doubles from its high.
actually, I want to say a lot higher, but I'm being very conservative. I mean, it really kind of so it really kind of come yeah, 5 years, you're right. It probably should be 2025. But it kind of comes down to, does something break? I mean, if we just kind of have continued high inflation, and we've had a very good run. I mean, gold was 2000 not that long ago, and we're at 4000 now. So my base case would be, 5 years, probably 15, something like that, maybe 2025. I mean, it could be 50, but I'm not saying it's going to be there. I'd be shocked if it's not 10. I mean, I think that next year it'll be 6 or 7 easily. And same, if I don't know if the next question is silver. I think silver, I'm with Michael Oliver. I mean, the silver shortage is real. The deficit's real. It's got two components, the sound money piece, but also the use in solar and all the other things we need, including these new batteries that are being developed. And so, I mean, silver, I don't see how it's not between 2 and 500 in 5 years. 200 is kind of really low case, and 500 is probably more realistic. And then Bitcoin, same kind of story. 5 years, I think the low case is kind of 180, 200, and the high case is kind of 400, maybe higher. I mean, the power law model on Bitcoin, which I think has very good predictive capability and has an R squared of 96% looking backwards, suggests that in 2032, now that's 6 years, that Bitcoin will be at $1 million. So, will it be there? I don't know, but I don't think it'll be at 60. I'm pretty sure it'll be in the hundreds. So,
All right.
yeah.
So that's quite a range of predictions.
Well, it's as you point out, it's so hard to know, right? What are they going to do?
I will say, last time you were right on your silver forecast. You did say it was gonna
break
triple
50 and
digits.
shoot higher, go through
It
100, right?
did, but also then it did, but dropped
But then it
since
came
then,
back.
as we know. But
Yeah, well,
but
and that's the problem. That's what makes this so tough. I mean, I put people into Bitcoin at 120 and they're calling me up screaming at me now. And I'm just kind of like, guys, you got to, let's get the big picture right. I think the big picture is the monetary debasement continues because of all the things we talked about in this interview. And if that's right, yes, at any point in time, you might have a drawdown, but you've got to give yourself kind of a 3 to 5 year window. And I think you're going to be happy with having done this. I think Rick Rule, who I respect a lot, I think he would say the same thing, right? That we're on the right side of this, but how we get to where we want to go, it's got a lot of zigzagging in it, right?
all right, we will leave it on that note. Larry, where can people find you? Where can they learn more
Yeah,
about you
so I'm
and your
on Twitter
work?
making a lot of noise, generally criticizing central banks at Lawrence Lepard. And then my partner David Foley and I write a letter called the Equity Management Associates Letter. It's quarterly, it's free. You can subscribe on our website. The most recent one just came out for June. Michelle was referring to it. I was referring to it throughout the meeting. And the website for that is EMA2.com. So EdwardMarkAlpha2.com. If you go on there and you click newsletters and you click Q2 letter, it's a PDF. It's 20 plus pages. It's long reading, but it's very comprehensive. We try to all the things I've been talking about, the math. We've been trying to show it very clearly there, so that this isn't like wild-eyed narrative speculation. This is actually based on analyzing the numbers and the facts. So.
And again, the big print, a must
Oh yeah,
read
well
for
that's the other
everyone.
thing. This is the book. The book is on Amazon. It's in 4 formats. It's designed to be an easy to read user's manual to why sound money is important and how we've been screwed by the government.
Yeah,
And
and what I like about it, it gives you some historical recaps along the way. And you know what they say, history may not always repeat itself,
it
but it
rhymes.
certainly does rhyme.
It definitely
And we are
rhymes.
out of time. I'm going to
Okay, yeah.
rhyme with the time. And thank you again
Yeah.
so much, Larry.
Thank you very
Lepard,
much,
always a
Michelle. Nice
pleasure.
being with
Thank
you.
you.
Enjoyed it. Thanks.
Thank you. And a big thank you to you for watching. Thank you so much for spending your time with us. We know that your time is valuable, and we do appreciate you choosing to spend it here on MFM. If you haven't already, please make sure to subscribe. Please do share our content and help us grow this community. Also, follow me as well as Miles Franklin Media on X and on Instagram. As always, do leave us your feedback. We may not always agree with your comments, but we like them. We like the spicy ones as well as the sweet ones, so keep them coming. Feel free to praise, whine, or just opine. And if you would like to learn more about building a precious metal strategy, you can reach out to info@milesfranklin.com. There's a team of specialized advisors and brokers that can guide you according to your own personal circumstances. Also, check out the website, milesfranklin.com. We will see you soon. Until then, stay sovereign.
This is The Real Story with Michelle Makori.